Hello everyone. Today, I'll be sharing 10 reasons why the crypto market is swinging. The cryptocurrency market has been volatile lately, leaving many wondering why the anticipated lift in value hasn't materialized. Let's go into the major reasons behind the swings we're witnessing and what's keeping the market from breaking upward. My name is Kelvin. Just for your information, I am not a financial advisor, so please do your due diligence and consult with your financial advisor. My videos are only for educational and informational purposes. So, having said that. 1. Geopolitical tensions. The first reason for the current swings in the crypto market is the rise in geopolitical tensions. Global conflicts, particularly in the Middle East, have shaken investor confidence across multiple markets, including cryptocurrency. For example, the ongoing tensions between Iran and Israel have created uncertainty, and investors are pulling back into safer assets. When geopolitical events like these escalate, they create an atmosphere of fear, pushing investors away from riskier assets like cryptocurrencies. One key reason is that when conflicts arise, energy prices tend to spike, specifically oil, which triggers inflation fears. As oil prices rise, the costs of goods and services increase, pushing central banks like the U.S. Federal Reserve into a tighter position regarding monetary policy. With inflation on the rise, they might not be able to cut interest rates, which keeps financial conditions tighter than many would like. This kind of environment makes investors hesitant to hold on to speculative assets, including Bitcoin and Ethereum. 2. Rising liquidations. Another significant factor contributing to the crypto market swings is the increase in liquidations, especially among long positions. When traders bet on the market rising, they enter into long positions. However, if the market moves against them, these positions are liquidated, meaning they are forced to sell their assets at a loss. In the past 24 hours alone, over $340 million in cryptocurrency liquidations have occurred, according to CoinGlass data. This includes a staggering $291.3 million from long traders who were betting on market upside. Liquidations cause increased selling pressure because traders are forced to sell their positions quickly, often at a loss, which contributes to downward price movements. As more traders exit their positions, the market becomes more volatile, creating further swings. It's a self-reinforcing cycle, where panic selling begets more panic selling, and the market continues to move in unpredictable directions. 3. Macroeconomic uncertainty. Global economic uncertainty is playing a crucial role in the current state of the crypto market. Rising inflation and interest rate hikes have cast a shadow over riskier investments, and cryptocurrency is no exception. Inflation has been creeping up in major economies, partly due to rising oil prices. This has led to central banks around the world, including the U.S. Federal Reserve, tightening monetary policies. Higher interest rates make borrowing more expensive, which reduces the amount of money flowing into speculative investments like crypto. In fact, rising interest rates are often used as a tool to curb inflation, but they also reduce liquidity in financial markets. When liquidity dries up, the demand for risky assets like crypto decreases, which in turn keeps prices from lifting. Moreover, the global economic outlook remains uncertain, with many analysts predicting a potential recession in the near future. This macroeconomic backdrop has created a cautious sentiment among investors, who are more likely to hold on to cash or invest in safer assets rather than pour money into volatile markets. 4. Stock market correlation. The correlation between the stock market and the crypto market has grown stronger in recent years, and we're seeing that play out now. Traditional equity markets, such as the S&P 500 and NASDAQ, have experienced significant pullbacks recently. On October 1st, for example, the S&P 500 dropped 1.1%, the Dow Jones fell by 0.7%, and the NASDAQ slid by 1.4%. These losses had a direct impact on the cryptocurrency market, with major coins like Bitcoin and Ethereum experiencing sharp declines as well. This correlation occurs because both markets often react similarly to macroeconomic news. When equities decline due to fears of inflation, interest rate hikes, or geopolitical instability, cryptocurrency tends to follow the same trend. As a result, even if crypto-specific fundamentals remain strong, the overall market sentiment can drag prices down. 5. Interest rate hikes and carry trade. Unwinding interest rate hikes, particularly by the Bank of Japan, have had a notable impact on the crypto market. For the first time in 17 years, the Bank of Japan raised its interest rates, leading to a phenomenon known as the unwinding of carry trades. Carry trades involve borrowing in a low-interest rate currency, such as the Japanese yen, and investing in higher-yielding assets, including cryptocurrencies. When the Bank of Japan hiked its rates, it became less profitable for traders to engage in these carry trades, which led to a massive sell-off in both traditional and crypto markets. Traders closed their positions to avoid further losses, leading to a reduction in liquidity and added pressure on cryptocurrency prices. The unwinding of carry trades is significant because it reduces the flow of capital into the crypto market. With less money entering the space, there's less buying pressure to support price lifts, resulting in more volatility and downward movements. 6. ETF market performance. The performance of cryptocurrency ETFs, exchange-traded funds, has a direct impact on the market as well. ETFs allow traditional investors to gain exposure to cryptocurrency without actually holding the assets themselves. However, when these ETFs perform poorly, it can drag down the entire market. For instance, if Bitcoin ETFs underperform, it signals to the broader market that investor sentiment toward crypto is weak. This can lead to a sell-off as both institutional and retail investors lose confidence. Poor ETF performance reduces liquidity and creates more market swings, making it harder for prices to stabilize and lift. 7. Fear and Greed Index. The Fear and Greed Index is a useful tool for understanding investor sentiment. Currently, the index is in a state of fear, which means that investors are risk-averse and hesitant to put money into the market. When fear dominates the market, there's less demand for cryptocurrencies, which prevents prices from rising. Fear-driven markets tend to see more volatility as investors react emotionally to news and market movements. This creates short-term price swings but prevents the kind of sustained lift that many investors are hoping for. As long as the market remains in a fear state, it's unlikely we'll see a strong upward trend in the near future. 8. Declining trading volume. Lower trading volumes have also contributed to the current market swings. Over the past few weeks, there's been a notable decline in the amount of trading activity in the crypto space. When trading volume decreases, it reduces market liquidity, making it easier for prices to swing wildly in response to even small trades. Low trading volume can signal that investors are on the sidelines, waiting for more clarity before re-entering the market. Without sufficient liquidity, prices can become more volatile, and the market becomes more prone to sudden moves, both up and down. Until trading volumes pick up, we're likely to continue seeing swings without sustained lifts. 9. Regulatory pressures. Regulatory uncertainty is a constant concern in the crypto market, and it's currently contributing to the lack of upward momentum. Governments around the world are debating new regulations that could impact the way cryptocurrencies are taxed, traded, and used. In the US, for example, there are ongoing discussions about crypto tax regulations, while the European Union has been tightening its oversight on exchanges. This regulatory uncertainty creates hesitation among investors, particularly institutional ones, who may be wary of putting large sums of money into a market that could face stricter controls in the future. Regulation is a double-edged sword. While it could bring legitimacy to the market, it also introduces new risks and uncertainties that can dampen investor enthusiasm in the short term. 10. Lingering impact of the FTX collapse. Lastly, the effects of the FTX collapse still weigh heavily on the crypto market. Even though the collapse happened some time ago, the shockwaves continue to reverberate. FTX was one of the largest crypto exchanges, and its collapse severely damaged investor confidence. While the market has shown some signs of recovery, it has yet to fully regain the momentum it lost. Many retail and institutional investors remain cautious, waiting for stability before re-entering the market. Until confidence is fully restored, it's unlikely we'll see the kind of lift that was once expected. Thanks for watching this video. I hope this breakdown helped you understand the key factors causing the crypto market swinging. Remember to stay informed and do your own research before making any decisions. Follow my account and stay tuned for more updates on the crypto world. Until next time, cheers.